Today we're going to introduce the concept of a lifetime financial simulation. It emphasizes the importance of finance education and planning from an early stage, highlighting that proactive financial decisions can shape long-term outcomes. The simulation will walk through a comprehensive plan for two individuals, illustrating how choices made today impact future financial stability and control over one's destiny. To figure out your financial picture, you start by looking at cash inflows, the money coming in. This includes your earnings after taxes and deductions, plus any extra money you receive, like gifts toward a house down payment, government program benefits, or a death benefit. Next, you list all your cash outflows, anything you spend money on. That includes bills, loan payments, subscriptions, food, transportation, and any other expenses. Anytime you make a transaction that adds to or subtracts from your assets or liabilities, you record it in the right place. For example, buying a car adds an asset, taking out a loan adds a liability, and paying down debt reduces a liability. Once you've tracked all your inflows and outflows, you end up with your net cash balance, the amount of money left over. That leftover cash can be used for saving, investing, or paying down debt. After you update all your assets and liabilities, you can calculate your net worth, which shows the difference between what you own and what you owe. Let's talk about net worth, and don't worry, it's way simpler than it sounds. Net worth is basically your financial scorecard. It shows the difference between what you own and what you owe. That's it. The formula is really straightforward. Net worth equals assets minus liabilities. Assets are things you own that have value, like money in your bank account, your car, your laptop, or any investments you might have. Liabilities are the opposite, they're the things you owe money on. That could be student loans, a credit card balance, or a car loan. And here's something important, it's totally normal for young adults to have a low or even negative net worth. You're just starting out. What matters is the direction you're moving in, building savings, avoiding high-interest debt, and slowly increasing what you own over time. Net worth isn't about being rich. It's about understanding where you stand today and making choices that help you grow financially in the future. Before we build any kind of financial plan, we need to understand the tools available to us. In Canada, there are several government-supported programs designed to help you save money, reduce taxes, and reach major financial goals like buying a home or preparing for retirement. Today, we're going to look at 4 of the most important ones. The Home Buyer's Plan, the First Home Savings Account, the RRSP, and the TFSA. Each one has a specific purpose, and when you use them strategically, they can dramatically improve your financial outcomes. Let's start with the Home Buyer's Plan. The HBP allows first-time homebuyers to withdraw money from their RRSP tax-free to help buy or build a qualifying home. You can take out up to the government's limit, currently $35,000 per person, and you won't pay tax on that withdrawal as long as you repay it over 15 years. The real advantage comes when you contribute to your RRSP first, get the tax deduction, and then use those funds for your down payment. It's a smart way to boost your buying power. Next is the First Home Savings Account, or FHSA. This is one of the most powerful tools available to first-time homebuyers because it combines the best features of both an RRSP and a TFSA. Your contributions are tax-deductible, just like an RRSP. But when you withdraw the money to buy your first home, the withdrawal is tax-free, just like a TFSA. There are annual and lifetime limits, but within those limits, your money can grow through investments and come out completely tax-free when you're ready to buy. If you're planning to purchase a home, this is usually the first account to consider. Now let's talk about the RRSP. The RRSP is a tax-deferred retirement account. When you contribute, you reduce your taxable income for the year, which can mean a significant tax refund. Your investments grow tax-sheltered, and you only pay tax when you withdraw the money later in life, ideally when your income and your tax rate are lower. RRSPs are designed for long-term retirement planning, but they also support programs like the Home Buyer's Plan and the Lifelong Learning Plan. Think of the RRSP as a way to shift income from your high-earning years to your lower-earning retirement years. Finally, we have the Tax-Free Savings Account, or TFSA. Unlike the RRSP, you don't get a tax deduction when you contribute. But every dollar your investments earn, interest, dividends, capital gains, is completely tax-free. And when you withdraw the money, that's tax-free too. The TFSA is incredibly flexible. You can use it for short-term goals, long-term goals, emergency savings, or retirement. There are no restrictions on how or when you withdraw your money. It's one of the best tools for building wealth over time because the growth is never taxed. So, to recap, the HBP helps you access your RRSP for a home purchase. The FHSA gives you tax deductions going in and tax-free withdrawals coming out. The RRSP reduces your taxable income today and supports long-term retirement planning. And the TFSA gives you complete tax-free growth and flexibility for almost any financial goal. Understanding how these programs work and how they fit together is the foundation of a strong financial plan. When you use them strategically, you can save more, pay less tax, and reach your goals faster. Before running any long-term financial projection, you need a consistent set of assumptions. The table provided establishes those assumptions, the rules of the game, that determine how every asset, liability, and cost behaves over time. Think of this table as the engine underneath the simulation. Every number you see later, cash flow, net worth, tax liability, investment growth, flows from these baseline rates. Investment growth rates determine how each type of account grows over time. TFSA, cash account, at 1%, represents a conservative, low-risk cash position. Useful for liquidity but not long-term growth. TFSA, long-term, RRSP and FHSA are at 5%. Assumes a balanced long-term portfolio. Investment other, 0% as these are used for assets that don't appreciate. Liability and borrowing rates determine the cost of debt. Operating line is 7% which reflects higher cost because of short-term borrowing. Mortgage, 4.5% is a realistic long-term borrowing rate. Investment loans and car loans forecasted at 5%. Gives mid-range borrowing costs that influence cash flow and net worth. Tax and pension adjustments at 2.5% ref. Reflects gradual increases in tax thresholds or bracket creep and it mirrors typical annual indexing of CPP/OAS. RRSP retirement tax liability at 17% is an effective tax rate in retirement. This directly affects how much of your RRSP is actually spendable. Home increase at 2% is a conservative long-term real estate appreciation rate. Auto depreciation with 20% as vehicles lose value quickly, this captures that reality. Inflation and wage growth. These are the backbone of any long-term model. Inflation at 2.5% drives the rising cost of living. It's also used to convert future dollars back into today's purchasing power. Wage increases A and B at 2% represent modest annual salary growth. The image shows how inflation and wage growth accumulate over decades. For example, by age 70, cumulative inflation reaches 361%. Meaning something that costs $1 today would cost $3.61 at age 70. Wage growth follows a similar compounding pattern. This is crucial because it reminds us that nominal dollars are not real dollars. $1 million at age 80 does not buy what $1 million buys today. By establishing these rates up front, the model can 1. Project investment growth realistically. 2. Estimate future taxes. 3. Adjust spending for inflation. 4. Track the rising cost of living. 5. Model home appreciation and vehicle depreciation. This shows how small rate changes ripple through decades of financial outcomes. This is the heart of scenario analysis. This outlines the education pathway and income progression, which we use as one of the 2 career profiles in the lifetime financial simulation. It highlights the upfront costs including tuition, textbooks, practicum expenses, certification, and ongoing professional fees, using typical ranges to create realistic early career financial assumptions. The slide also maps a full career timeline from now through senior roles, showing steady income growth from a first year to higher positions. These salary bands are built directly into the simulation to demonstrate how a stable, pension-supported career influences long-term outcomes such as savings, housing affordability, and retirement security, and they set up a comparison with a trades-based career later in the presentation. This sample teacher mission statement highlights a commitment to living with integrity and purpose across all areas of life. It emphasizes professional dedication to teaching, personal financial responsibility, the pursuit of a strong and loving family life, and meaningful engagement in the community. At its core, it reflects character-driven objectives, choosing honesty, service, and ethical action as guiding principles for building a purposeful, stable, and compassionate life. By age 18 was working part-time and during summers, and after graduating from university at 23 began full-time work, took the one-time student loan credit, and started contributing to the pension while paying union dues. At 29 then moved to a higher pay level. At age 18, I began my education toward a teaching career while living at home until age 23, relying on public transit and occasionally borrowing my parents' car. During this period, I incurred personal expenses that included a $10,000 annual student loan for 5 years, which I then began repaying over the standard 15-year term. At age 23, I purchased my first car with financing and started accumulating furniture for my own place. Cash is moved in and out of my TFSA as needed. This outlines the training path, costs, and income progression for the second career profile in the simulation. Training costs are relatively low and spread over time, while income starts early and increases each year. This mission statement reflects an electrician committed to mastering the craft and delivering safe, high-quality work grounded in professionalism and integrity. It emphasizes continuous learning, strong relationships, community involvement, and a lifestyle shaped by honesty and gratitude. It highlights a dedication to meaningful work, physical well-being, and ethical choices that support a purposeful and responsible life. Wages increase each year throughout the apprenticeship, reflecting the normal progression from beginner to fully qualified worker. At age 28, income jumps noticeably, representing promotional increases or advancements in responsibility. At 18, while living at home, purchased a partially financed car and began an apprenticeship. By 21, with extra cash available, opened an FHSA for a future home purchase and started a TFSA to improve returns and avoid tax on savings. At 22, after completing the apprenticeship, moved out to share accommodation with a friend and began buying furniture, and at 24, traded in their original vehicle and purchased a newer model with partial financing. The household's income profile reflects 2 stable career paths, each contributing to long-term financial security in a structured and predictable way. The electrician maintains consistent employment with regular wage increases throughout the working years. A significant milestone occurs at age 44, when a promotion results in a meaningful boost to annual earnings. Beginning at age 50, the electrician also initiates RRSP contributions, strengthening the couple's long-term retirement savings strategy and enhancing tax efficiency. The teacher continues in a steady teaching role, supplemented by summer employment during the early career years. At age 36, the teacher takes a 1-year leave following the birth of a child, during which summer employment ceases. From that point forward, income is derived solely from the teaching position. Payroll deductions consist primarily of union dues and teacher pension fund contributions, which support long-term financial stability and professional security. Together, these income patterns create a reliable foundation for the family's financial plan. The combination of career progression, disciplined retirement contributions, and thoughtful adjustments during family-building years ensures that the household remains well-positioned to meet both short-term needs and long-term retirement objectives. The worksheet illustrates the shift from single life at age 32 to married life at age 33. At 33, the major financial change is the purchase of a condo, reflected in both the new property value and the corresponding mortgage. The FHSA savings, along with the investment growth accumulated in earlier years, were applied toward the home purchase and are shown as part of the income cash flow for that year. Additional spending included home improvements and the purchase of engagement and wedding rings. No wedding expenses were budgeted because the event was expected to be a small family-supported gathering. In the years that follow, the condo value steadily increases while the mortgage balance declines. Any surplus cash was directed into the TFSA rather than toward accelerated mortgage payments, based on the assumption of higher investment returns. At age 36, the arrival of a child brought a temporary shift in income. One partner stayed home for a year and received EI instead of employment income, and a newer vehicle was purchased to accommodate family needs. By age 37, childcare expenses increased due to daycare, but higher household income more than offset the added costs. At age 42, the family upgraded vehicles again, taking on a new loan. At 48, there was a death in the family, resulting in a $400,000 cash inflow, which would be $200,000 in today's value. This allowed a transition from the condo to a more suitable house. Both the property value and the mortgage increased, along with higher ongoing home-related expenses. At age 49, another vehicle upgrade occurred. By age 50, the long-anticipated family dog joined the household, and contributions to the RRSP began, reflecting a shift toward long-term retirement planning. Between ages 51 and 69, long-term retirement strategy transitions from the accumulation phase into full implementation. The electrician continues to earn employment income through age 65, with consistent RRSP contributions each year. This disciplined approach builds a strong tax-deferred base prior to retirement. At age 65, the electrician retires and begins drawing structured income from the RRSP. Withdrawals are intentionally managed to keep taxable income within an optimal range, reducing the overall tax burden. TFSA assets complement this strategy by providing tax-free liquidity for larger discretionary purchases, ensuring that RRSP withdrawals remain stable and tax-efficient. This combined RRSP-TFSA approach provides predictable income and continues to support lifestyle needs throughout the retirement period shown in the projections. The teacher retires at age 60 after 37 years of pensionable service. This results in a substantial defined benefit pension that replaces a significant portion of pre-retirement earnings, as reflected in the steady income stream beginning at age 60 in the spreadsheet. At age 65, government pension benefits begin, providing additional stability. Due to income levels and federal clawback rules, Old Age Security, OAS, is not received. Together, the electrician's planned RRSP drawdown strategy, the teacher's long-service pension, and the coordinated use of TFSA funds create a resilient and tax-efficient retirement income plan. This structure ensures that both essential expenses and discretionary lifestyle goals can be met comfortably throughout the retirement years. The financial plan for the coming years is structured around two core priorities: maintaining a fulfilling lifestyle today while building toward long-term retirement security and financial independence. The strategy focuses on preserving your investment capital so that, over time, you can rely primarily on portfolio gains to support your lifestyle rather than drawing down principal. As outlined in your projections, major discretionary purchases, such as new vehicles at ages 54, 60, and 66, are funded through TFSA investment growth rather than through borrowing or cash flow strain. Ages 67 to 69 shows a negative value in TFSA. We assumed it's covered by an operating loan on the house. This approach keeps liabilities low and allows your tax-advantaged accounts to play an active role in supporting lifestyle goals. We allocated increased funding to child-related expenses during the education years, ensuring that these costs are fully covered without compromising your broader financial trajectory. At age 58, pet-related expenses naturally decline with the passing of the pet, and it was chosen not to take on additional long-term commitments in that category. This reduction, combined with disciplined planning across all other spending areas, results in consistent annual surpluses. These surpluses give you meaningful flexibility. You're able to allocate more toward discretionary categories, such as entertainment, dining, and travel, without jeopardizing your retirement objectives. In fact, the plan shows that you can enjoy these experiences while still maintaining your net worth and maintaining a sustainable long-term outlook. Overall, your financial roadmap reflects a balanced, forward-looking approach, enjoying life today while ensuring that future retirement years are supported by stable, resilient investment income. From ages 70 through 89, retirement plan enters a period of long-term stability. The combination of the teacher's defined benefit pension and the electrician's structured RRSP withdrawals provides a consistent and reliable income stream throughout these years. These sources, supplemented by earlier TFSA planning, are sufficient to cover all projected living expenses without requiring any drawdown of core investment capital beyond the planned RRSP strategy. The pension continues to deliver predictable, inflation-adjusted income, while RRSP withdrawals are maintained at levels aligned with tax-efficient retirement income planning. Together, these income sources ensure that your lifestyle remains fully supported well into later retirement, with adequate flexibility for both essential and discretionary spending. At age 70, you downsized your home, which provided a $1 million cash injection. The following year, at age 71, an inheritance added another $100,000 to your TFSA. We estimated your future tax liability at approximately 17%, reflecting the lower tax bracket you were in during those years. At age 78, you transitioned into rental accommodation, reducing your housework and maintenance responsibilities. This move generated an additional cash injection of more than $2 million. During this period, you also purchased a few newer vehicles. The end result is a net worth measured in the millions. However, when viewed through the lens of long-term inflation, the real purchasing power of those amounts tells a more modest story. What you're looking at here is a series of adjustments to the core assumptions in the model, changes to investment returns, inflation rates, and wage growth. And as you can see, even small shifts in these inputs create a noticeable impact on the long-term results. These factors compound over decades, so the ripple effect becomes dramatic very quickly. That's why it's so important to revisit your financial forecast regularly. As these underlying assumptions change in the real world, your plan needs to change with them. Updating the model ensures that your projections stay accurate, relevant, and aligned with the economic environment you're actually living in. With our integrated database, forecasting workbook, and step-by-step instructions, the entire process becomes simple and efficient. You can build and update your financial plan in minimal time, with clarity and confidence. This toolkit isn't just helpful, it's essential for creating a successful, empowered life built on informed decisions and long-term control.